I'm super excited that we're now going to build on what we've done, and we're going to build both an income statement and a balance sheet for a company that I'm going to call Cobble Hill Inc. Now, the transactions that we're going to record are in row 7 down, and there's quite a few, so it's going to take us a bit of a time to go through this. Then we have our balance sheet in row 32, and then we also have our income statement starting in row 73. Let's see if we can get this all working together. Here we go. So we're going to issue common shares for 1,000. So we're going to have cash of 1,000. Oops, I'm going to put an equal sign so I can record all my transactions and see those transactions if I look in the cell. And our common shares, oh, there was already a number in there that should be 1,000. Let's get that in there. Our balance sheet balances, and this transaction doesn't hit the income statement, so we're good. Now we borrow 400. Where it says repays loan, but there's nothing there, but we're paying interest. So we're borrowing 400, but paying interest is an expense. So let's do the borrowing first. So we borrow 400. So let me get up here. Our cash is going up by 400, but we also owe, and we're going to assume it's long-term, we owe 400 to the bank. Our balance sheet balances. That transaction doesn't hit the income statement, but now we do have one, and we're paying interest. And just to remind you, we are paying interest of 24. So remember, we are increasing expense. That's a debit. Now we're going to record it separately on the income statement, but we need to also make sure that anything happening in the income statement does still feed through into equity, and in particular into retained earnings. So let's actually scroll down here, and we have interest expense, and that's minus 24. And then we have cash going down by 24. Now you're going to see that our balance sheet isn't balancing by 24. And that's because there's one critical thing missing. We haven't plugged the income statement into retained earnings. So what we need to do is make sure that in cell E61, we link the income statement, in particular, the very bottom, what's being retained, to and into the balance sheet. And when we do that, you can see that our balance sheet now balances. Okay, let's keep going. We buy property and equipment, or property and plant, for 900 with a 10-year estimated useful life. And that's because we're going to calculate depreciation on this. But let's just start with the property. We are decreasing cash by 900, but we are increasing another asset, which would be a debit, recall, by 900. Now, let's actually talk about that depreciation. We're going to assume straight line depreciation. We're going to assume zero scrap value. So all we need to do is to calculate the depreciation, take 900 and spread that expense over 10 years, which is going to be 90 a year. Now, what we're going to do is there's two aspects to that. We're going to have to adjust the value of the asset, but we also have a depreciation expense, which is on the income statement. So let's capture that depreciation expense, minus 90. And let's just make sure, you probably can see it here. Here's the check. Good, our balance sheet is still balancing. Okay, now we're going to buy inventory for $350, but some of it's on credit. So we're paying $320 in cash, which means $30 is still owed at the end of the year to our suppliers or accounts payable. So we're buying inventory, but I'll do the cash first. Minus $320, but we have $350. But we also have accounts payable now of $30. Let's make sure the balance sheet still balances. Good. We've done those transactions correctly. Now, what I'm going to do is go to the next bit, and now we're going to sell the inventory for $510, and we're going to get cash received from sales of $430. Okay, so recall, therefore, the difference is going to be accounts payable, accounts receivable. And if you want to figure out what that accounts receivable is, it's just going to be the $510 minus the $430, which is $80. So let's do that first. We're going to get cash in of 430, but we're also going to have 80 of accounts receivable. Now, we're going to be out because we haven't recorded the revenue on the income statement. The revenue will then feed down to net income, then into retained earnings. So our balance sheet should still balance, but let's actually make sure that revenue is in. And the revenue, recall, is 510. So I'm going to capture the revenue. And we then have retained earnings at 396, which means our balance sheet is still balancing. We haven't finished that, though, because we have to actually record the expense of the inventory. And we're assuming in this case, we're selling all the inventory. There's not a percentage there. And so I lied because, of course, there's inventory left at the year end of 60. So let's actually make sure that we take off the inventory. So that means we have 350. We know there's 60. So we've sold 290. So what I'm going to do is I'm going to put an equal sign there. I'm going to make sure I'm going to minus 290. So we're decreasing an asset. That would be a credit. We know that there's 60 left at year end, but that 290, remember, is the expense or the cost of goods sold. So our balance sheet's not going to balance. It's out by the 290 because we haven't recorded the cost of sales on the income statement. So let me put the 290 in there. And you can see our balance sheet balances. We're starting to get more of a complete income statement, but we're not done yet. There's a couple of other things we need to record. So we pay expenses of 40. We're going to be paying tax at 30%, and we're paying a dividend. So the 40 of expenses, let's do that. That's 40. I always start with cash. But we have expenses of 40. Again, our income statement is feeding through correctly into our balance sheet. We know that because the balance sheet continues to balance and the accounting equation holds. Now, we're paying tax at 30%. So what I've done here is I've linked it to E90. It's because what we're going to do is we're going to just use a formula here. We're going to go equals minus, because we want it as an expense or a negative sign, profit before tax or earnings before tax times 0.3, which is 30%. That's 20. You can see there's the 20 there. But our balance sheet, let's check if our balance sheet balances. It doesn't. Why not? It's because we haven't actually deducted the cash. So now let's deduct the cash. Oops, and let me get that on the screen. I'm going to go minus 20. And hopefully now our balance sheet balances, and it does. Good. Okay, so now we're almost done. There's just one more thing to do, and that's the dividend. So let's look. We pay a dividend. That's out of cash of 30. So let's reduce the cash by 30. And then what we're going to do is actually record that dividend because net income is 46, but what profit is retained in the business is after we pay out dividends, which is 30. And so the retained earnings are 16. Let's just check the balance sheet balances. It does. Congratulations. You've recorded not only a balance sheet, but also a separate income statement. Now, I'm even more excited to take you through year 2, because what we're going to have to do is build on year 1. In particular, we're going to need to start with the balance sheet, and we need to recall that the balance sheet is a snapshot at a point in time. So at the end of year 1, we actually have the balance sheet, but those account balances become the opening balances for the next period or year. So before we record any transactions for year 2, we need to transfer the account balances, the closing balances, to make them the opening balances for the new year. And we can do that by just using equals and linking the two together. And I'm going to go Control C, and then I'm using Pay Special. With Pay Special, you can choose, whether you want all, but I just want the formula. I don't want the formatting, for example. So I'm just going to hit OK. And then I'm going to, instead of doing Pay Special, I'm going to hit F4, which is just repeat command, as a quick way to get these all filled in. So now our closing balances from the previous year are our opening balances for this year. Now we can start recording transactions. So let's actually work through those. The key question to ask always, is the transaction going to hit the balance sheet or the income statement or both? So here we have a loan being repaid. That means our cash is going down and the loan's going down. So that won't hit the income statement. So let's actually capture that. Minus 100 of cash, and the loan goes down by 100. Balance sheet balances, we're good. Now let's do the interest expense. Remember, expenses are on the income statement, but it's also going to hit cash. So let's reduce our cash by 18, but also let's record an interest expense of 18. Now you're going to see that there's a tax expense already being recorded here, but let's actually delete that for now. And I'll tell you why. We want to make sure we are linking our retained earnings or our income statement back into our balance sheet. So we're going to have to go the opening balance, but plus whatever our retained earnings are for our current year. Good. We get the balance sheet to balance. Total assets equals total liabilities and equity. Now what we're going to do is we're going to do another transaction. Now, one of the things we may want to do is think about that property, plant, and equipment. It's year 2. We need to actually record a depreciation expense and reduce the value of the asset on the balance sheet. Recall that it is straight line. Its useful life of 10 years. So it's just depreciation expense similar to year 1 of 90. There's no cash involved. So the two transactions are, we're going to reduce the value of the asset on the balance sheet by 90. But we're out by 90, and that's because we have to record the depreciation expense on the income statement of 90, which then feeds through to a new retained earnings number. Okay, so now we've done that. Let's talk about buying inventory. We buy inventory for 100 and we pay 380, which means that we owe 20 to our suppliers or accounts payable. So let's increase the inventory by 400, reduce our cash by 380, and increase our accounts payable by 20. Good. Nothing hit the income statement here. Not yet anyway. Maybe later on, but our balance sheet still balances. Now we sell the inventory. So we're going to have revenue. And the cash received from sales is 480. So that's going to be hitting the balance sheet. But we also didn't sell all the inventory because there's still 80 of inventory at the year end. So actually, let's do the sales first. So that's revenue. We're going to go to the income statement. That's going to be 550. Now let's record the balance sheet aspects to that, because what we have of cash, 480, but there's 70 that is owed from our customers. So that means our accounts receivable goes up by 70. Let's just do a quick check. Good. Our balance sheet is still balancing, but we haven't recorded the expense of selling the inventory. Now, one of the things we have to think about is how much of that inventory was sold. And the way we figure that out is by looking at how much inventory is left. So we know the balance sheet has to have inventory of 80 at the end of the year, but we see it's at 460. So how do we get down to 80? Well, clearly what we must have sold is 380. And let's just check. I'm going to minus 380 here. Make sure we end up with 80 of inventory. Perfect. But that's a cost of sales or cost of goods sold. So we're going to have to capture that on the income statement. That's minus 380. And our balance sheet and our accounting equation holds. We're almost there. Now we have a couple of other things to do. We need to pay expenses of 50. Let's do that. Cash goes down by 50. And we have to record an expense on the income statement of 50. Good. Accounting equation right here at the top still holds. Let's do the dividend next because that's really easy. Pay a dividend of 5. So our cash goes down by 5. And here's our dividend of 5. Hopefully we're still balancing. Yep, our accounting equation holds. And the only thing we have to do next is record the tax expense. Now, I'm going to just copy the tax expense from the previous year. I'm doing Control-C and just Control-V for paste. Now, we are almost there. You can see our balance sheet doesn't balance because we've recorded the expense of tax, but we also have to deduct that from cash. And we can see that's 4. So I'm going to deduct the tax expense of 4. And we have done it. Let's just do one final check. Our income statement balances, we have a full, the income statement is done. The balance sheet balances, retained earnings is feeding through. Congratulations. You've just built a full balance sheet and income statement for a subsequent period.